Monday continues as Margaret Lomas and her team answer all on Your Money, Your Call.
Good evening and a very warm welcome once again to your Monday night property edition of Your Money, Your Call. As we now run for an hour and a half, you now get the chance to ask more questions and to get more information and more guidance from my selected experts each week. Joining me tonight are regulars Brad Beer from BMT and Brad Matthews from Rescom. And this week, as well as discussing what's making news, we're talking buying property in Melbourne, the hot spots and the not spots. And Brad Beer will be telling us about some of those depreciation schedule benefits that a lot of investors know very little about. As always, you're invited to join the discussion. Now, you might like to just make a comment about our headline topics, or perhaps there's a burning question that you have that you think we can answer. Whatever your purpose, there are three ways that you can contact us. You can call 1300 30 34 35. You can email property@skynews.com.au. And now you can tweet your questions to me on Margaret Lomas AU. Thanks for joining us tonight and welcome to the program. And welcome to you both.
Margaret.
Brad, thank you for coming along because it's good to have a Melbourne expert here. And you've been working in and around Melbourne for a long time. You were born in Melbourne and raised in Melbourne as well, and I know your business is heavily concentrated around there. I'd like to start tonight by talking about the areas in Melbourne that people should stay away from.
Yep.
Because a lot of attention is coming on to Melbourne now that Sydney's kind of reached that unaffordable peak. People are starting to look down in Melbourne. What should they be careful of?
Personally, myself, professionally as well, I would be staying away from, in a residential sense, from Melbourne CBD. In that inner grid and probably a little bit of Docklands. Melbourne CBD, there's nothing against it residentially. I live there. I have no issue living there, but as an investor, I wouldn't buy an investment property there.
Too much supply, isn't there? I mean, you only have to go there to see the cranes.
Yeah, so cranes, you know, within the CBD grid, I can remember listening to premiers doing media releases over the years saying what a fantastic sign it is for whatever economy you may be in around the world. If you see cranes on the city skyline, it's always a good sign, which is right if you're a developer. Fantastic if you're supplying white goods or if you're a tradesman. But if you're an investor, I wouldn't have an investment property there. I would live there. I have no issue with living there. I would have no problem buying a property to live in that area as well. But if I was buying investment properties, then I definitely wouldn't look at the Melbourne CBD.
What about some of those areas that are just fringing, like Carlton and those areas?
Yeah.
What do you think of those? Because a lot of people ring the show and ask about them.
Yeah. So Carlton is a fantastic area to live again, right? Fantastic. My wife and I, we go to the shops there all the time. Yeah. We go to the restaurants. We walk up there and say, I can't believe, you know, we live a K from here and we don't go there enough. But then we look around, we're looking up and there's places still going up there everywhere. So again, Carlton is a fantastic place to live, right? It's a fantastic place to buy a good residential property, but it doesn't necessarily mean if you're buying an apartment in a block of 150 or 200 that it's going to be a good investment. In all likelihood, it won't be, because there's multiple blocks just like yours being built all the time.
Yeah. Of course, Brad B, the problem, of course, is exactly what Brad's saying. There's so many of them and they're all alike. You guys see them because you go and do the depreciation schedules on them. And, you know, a block of 70 apartments and they're all identical. You're likely to be trying to sell yours at a time when a number of other people are. With so much on offer, it really affects the prices.
And it does when there's so many being built at the same time. We tend to have the little herd mentality in this country. When people buy property and make some money out of property in Melbourne, we then start building heaps of them, and then we tend to always overbuild in those areas, and you've got such a competition of so many that are the same next to each other. Now, we're almost like some of the tradies. Investors do buy them at some point, and then it's just a matter of pricing, though. Sometimes they buy them when they're less expensive, and we end up doing depreciation schedules, which is just seeing cranes in the sky is not always good for everything. There's lots of jobs going. I suppose the construction industry is strong when that happens, but if the property prices go down a long way by the time these things finish, then there's instantly way more less jobs all of a sudden because they finish off.
And often the people who are working on those, they live out in the suburbs anyway, and so really, if there's a lot of construction work and a lot of construction jobs going, you want to be buying property where all the construction workers live, wouldn't you? Where the employment is. I mean, the employment's in town, but they don't live there. They don't live in those units. They live out in the suburbs.
Quite often, yeah. Well, they don't live in those units because they're not built.
Yeah, but even the ones that are built, they don't, you know, they're not going to live in one and go and work on the other. Usually the construction workers have the families don't live in the units. They live out in the suburbs with the families, and that's because of all of this construction, jobs are very healthy in Melbourne, and there are areas to buy in.
And there's too many all at once in the same place that are the same. If any of those sorts of things, especially as early investment, first investment, much more risky because you're punting on what happens in a market when it settles, and you really don't know, especially when so many are being built at the same time. It comes up to the point if you're forced to have money to settle and the prices haven't moved, or APRA's clamped on the banks and made it so you need more capital, it's a big risk unless you're really an investor with plenty of equity to spare in those situations, and then maybe you should look at things that don't need to chew up that equity in that situation. All our investing, I think, should be considered, in my opinion anyway, long term, and if you've got time, then sometimes it's not as bad in some respects, but then wouldn't you look for something that you think is going to grow faster and not have so many there?
Exactly. Well, look, let's go to the phones now, and I know Michael is waiting on the line. Michael, how can... Michael?
Hi, Margaret.
How are you going?
Good, yourself?
Good. What can we do for you?
I just wanted to get your thoughts on the Shellharbour area as an investment, just especially as the marina is going in down there.
Right, okay, yeah. Look, I was actually down in Shellharbour recently. I went down and had a little look around Shellharbour, Kiama, Wollongong, and thought that Shellharbour was, again, a great place to go down and have a look at. And lovely to go down there to visit, and beautiful to live in. There's a marina development going on down there. Brad, what do you think about areas like that?
Look, marina development or small development is very sort of holiday focused, I suppose. Shellharbour is not necessarily an easily commutable distance back to Sydney to work if you do need to. I think buying just because of one particular project like that is probably something that's not necessarily an awesome idea. Sounds like fantastic. It's like every time I go to Noosa, I want to buy something now, I think. But I try, because it's such a beautiful place. I haven't.
So glad you haven't.
But beautiful places is a bit like almost investing in holiday accommodation sometimes, that I think those decisions should be made as investment decisions, not as, well, this is great and it's also got a marina, it's fantastic, so therefore we should buy property there. What are the underlying drivers of jobs and things in that area are probably sort of more important considerations, rather than maybe the holiday house because I like it, it's got a marina and I want to go there and visit it.
Brad Matthews, of course, Shellharbour is south of Wollongong, and Wollongong had a fair bit of growth. I guess they got some of the way from Sydney. Even before Sydney went, Wollongong was getting a lot of attention once it stopped being in liquidation, which it was for a while. And then I guess Shellharbour kind of got pulled up by that. As a long-term option, do you think those kinds of areas work?
No. Having been bitten myself on things like what Brad said about before, about the holiday destination and external factors that only drive something for a short period, and when a short period I'm talking anything from 6 to 24 months. If you have something that has an underlying driver, whether it's universities, whether it's hospitals, whether there is an industry there that doesn't rely a lot on external factors, Michael, that's where I would be looking. Yeah.
Yeah, okay, so that's great advice, and I agree. Look, as I said, I went down there, had a look around, really enjoyed the place, enjoyed the restaurants, met the mayor, as it turned out, in a restaurant, and really enjoyed there. But I'm just not sure, as far as an investment goes, that your money is best placed there. If you're looking to go and live there, I agree, it's a great place to live. For a long-termer, you probably won't lose money, and you might even get a bit of a gain. You'll get a fairly good rental yield, probably around the 4.5%. It could be better, but I wouldn't be saying that it's necessarily a hotspot, at least not for now. Well, let's take a look at Andrew's question. It's come in on our email and he says, great show. I'd like to hear the panel's thoughts on purchasing a block of units. I already have 2 standalone investment properties, but I'm thinking of investing in a small block of units. I'm wondering what the pros and cons are and if I should stick to investing in individual properties. 2 properties he's already got. I don't know that that actually makes him a really experienced investor, Brad. What do you think? What's the pros and cons of buying?
There are a few pros and cons on this, Andrew. I'm a little bit biased because we actually do that within our business, and we've had hits and misses, some that work and some that don't. But the part that I like about it is that you own the block now. The little asterisk that I'll put at the bottom of this is, how many are you looking at in a block? Are you looking at a block of 2, a block of 3 or 4, which is, pretty good for somebody who's an individual, or are you talking about a block of 10 or 12? Are you talking about 2 bedrooms and a bathroom? Are you talking about bed sitters? There's all different things behind, just a general advice on a block. But if you're talking about something that is just 2, 3, 4 units on a block, 2 bedrooms, there's nothing specialised about them. They're easy to borrow against, which is the main thing, because you have to look at, as being a borrower today, somebody has to buy off you tomorrow. So you want something that is readily marketable, and it's not a small bed sitter, it's not specialised, you're not buying this block because it's affordable because it's on the back of a freeway or anything like that. You're buying just a standard block of units. I like the fact that you can then, by having the whole block, you control the owner's corporation or the common property, so you can actually do things to that block yourself, either using your own sweat equity or some friends, and you can actually add value to it in the ordinary sense that you can't do when you're one of 4 or one of 6 in the block and you have to get 5 other people to buy in with you.
That's very true. Brad, I guess he needs to be careful about it not being too big a block, otherwise he's putting all of his eggs into the one growth basket as well.
And then the size of the block is probably one of the important questions for me. I think I agree absolutely with the fact that you've got probably potential to add some value with a block of units because you control the whole of the strata. You've got the ability potentially, if it's the type of block that can be split up, strated afterwards if it's not already strated, so you might be able to sort of pick up and be able to even sell some of those and make some profit out of it at the end, or individually finance them, strated afterwards. Depending on how many you own, you might have reduced LVRs from a finance perspective. And I think being someone with 2 investment properties at the moment, Andrew, is moving into the block of unit land when LVRs potentially are lower, money required to do those things is probably something that's not the simplest at that early stage. I've got a number of properties, haven't bought blocks of units, but have considered that, and it's probably something that at my point with level of equity, etc., that's probably more something that I'd be likely to do. Same with sort of like developing, because you're kind of getting, if you're trying to buy and try to renovate blocks of units, if they're not small 2, 3 type things, you're getting into a bigger space where you probably need more available cash flow, more available equity, or more borrowed equity and access to the cash if you need to do things. If you're not in that position, and 2 investment properties is, unless you've got large other income, is probably not that. Sticking with the basic, simple, add value, quicker things that you can buy sometimes, I think, is probably what I do at that stage.
Yeah, look, I've got just a couple of small worries about it, and that goes back to the size of the block as well. If you're talking about 4, for example, and you've got 2, then that means straight away that 66% pretty much of your entire portfolio is tied up in the one asset, really, even though there could be 4 separate units, which means that if that area doesn't grow, a significant amount of your equity is tied up in an asset that isn't growing. When someone first starts out, I like to see them really diversify well amongst many different areas, and this doesn't give you the opportunity to do that. The only other thing I'm really worried about is that very often the blocks of 3 and 4 aren't already strata titled, so they might be under the one title. The bank might give you a reduced loan to valuation ratio under that circumstance, down to 70%, but you also have to think that when it comes to sell them, the person who's going to buy it off you also has to get finance, and they might be under a reduced LVR, and it might remove some of the people who would otherwise buy it, so it might make it difficult for you to resell them. If they're strata titled, well and good, and if they're not and you want to do that, just bear in mind that it isn't as simple as you think, and there are quite a lot of costs involved in strata titling, so you would have to add that to the whole thing to make sure that the project was going to pay off if you decided to strata title. Very often for an all-in-one line, the bank will value it lower as well. So if it's not strata titled, you may get 10, 15% less valuation across the 4 of them or the 3 of them than you would if they were already strata titled. Well, thanks for tuning in. As we always do, you can get the chance to receive a copy of one of my books just by joining in on our conversation. Each Monday night, the panel and I choose one question from either the calls or the emails. The latest book, How to Achieve Property Success, will be sent to that person. And if you're ready to invest, this book will make sure that you cover every single part of the process. Now, all you have to do is call us on 1300 30 34 35. Email us on property@skynews.com.au or tweet us on Margaret Lomas AU with a question, and then make sure that you watch at the end of the show to see if you're the lucky person. It's time now for us to go to a break. Don't go away. When we come back after these few messages, we're going to be taking more questions and emails. We'll see you soon. Welcome back. Thanks for joining me for the extended format of Your Money, Your Call. I'm Margaret Lomas, and joining me tonight is Brad Beer from BMT and Brad Matthews from Rescom. So don't waste any time. Call us now on 1300 30 34 35. Email us on property@skynews.com.au, or now and from this week on, you can tweet Margaret Lomas AU. Rakesh, thanks for joining the program.
Margaret in the panel, I really like your program.
Thank you.
Okay, we are thinking of buying far in northwest corner of Sydney.
Yes.
After Kellyville. Now the property ticks all the boxes for us, either for our own living or for investment. It's about 20-year-old. It's completely renovated. It's perfect, shining. But there's got one handicap. We've got a pad station in front. It's a transformer on a pad. Now, is it a property worth looking at, or should we just get out of it?
Okay, so this one's in Rouse Hill. Rouse Hill, all right. What do you think about having an electricity transformer across the road?
Rakesh, exactly what you're going through now, when you go to sell it, every other buyer is going to be going through the same thing. So if you're ringing us up to question it, how do you think other people who may not be as educated as you would think?
And
they
we
won't
may not
even
be
ring
around
up.
then
That's
either
right,
to answer the question.
So there's always this unknown factor. It doesn't matter where you go around the world, that virtually anywhere where there's a lawyer that has the ability to sue somebody will be looking for properties or owners of properties like yours, or like what you're looking at. That's how I look. Why would you throw yourself in at that end?
I think more than that. I think Brad's main point, Brad, is the fact that, it's getting confusing, is the fact that there are going to be people who won't buy because of that, because of that feature.
And I think that anything that impacts on that, whether it be right or wrong, that's actually going to impact on you. You could probably get plenty of conspiracy theories. Like, we still use mobile phones, and that sort of whole thing kind of disappeared lately. I was thinking the last week, but if you're concerned that maybe that's an issue, so will someone else who potentially looks at that property at a later date. So if there's enough, I suppose, discounted value on that property to consider it, considering someone else that may want to buy it from you in the future, or a valuer that looks at it on the way through, or a renter who looks at it if you do decide you want to rent that property out, everyone's going to be thinking the same thing as you. Whether or not it's actually going to affect you or not is irrelevant. The fact that everyone's going to think that is going to impact all of those things.
But I guess if you get it cheap and you have to rent it a bit cheaper, and then you just have to sell it a bit cheaper, then all things may be equal. Yeah. But so you don't know what the position's going to be. And I guess it's important to note that maybe in the time that Rakesh owns his property, they'll come out with the evidence that living near an electricity transformer causes some kind of terrible disease. And if that's the case, then he's got a property worth nothing.
They may come out and say that living next to it has absolutely no effect on you as well.
In which case, then he could do well. So, but it is a risk. So, Rakesh, look, many years ago, when I was much younger, we bought a property to live in, and it was a block of land and we built on it. And because it was a tiny little bit cheaper than the rest of the blocks of land, we bought the one which was up against the wall that went along the main road that was next to the estate. So everybody else didn't have a wall along the main road next to the estate, and we did. And when the time came to sell, we definitely took a hit on that. We definitely had to sell that considerably cheaper than everybody else. Even though everyone else was only 1 block or 2 blocks or 3 blocks away from that wall, the fact that we were on that wall and we had that main road and everybody said we were on a main road made a difference to our value. And I think you have to take that into consideration. The fact that it will affect your value, but by how much nobody can tell you. Will it get worse or better? Nobody can tell you that either. If you're prepared to take that risk, and if you know you're getting a good buy and you may have to rent it out cheaper, but you're prepared for that, then well and good, go ahead. But I would suggest that it is an issue, and that's probably why this property's there and still on the market. So I personally would stay away from it. Fred, you're calling about Liverpool.
Yes, I am. G'day, guys. How are you?
Good. How are you? What can we do for you?
Very good. There's a lot of units going up, new units going up in Liverpool.
Yes.
So I just wanted to get your opinion on, is it a good time to buy now or should I be waiting?
Okay. The thing about Liverpool as well that I want to point out, gentlemen, is that I've had a look at Liverpool recently, and there's a big difference in the price of the new ones and the established ones. Mm-hmm. The same size and shape of unit, not that far from each other, there's $100,000 difference in them. And I have to ask the question whether in another 5 years' time, when the new units are 5 years old and the old units are 15, and there's not that much of a difference between them, whether that 100,000 will stay, right?
Yeah. The way I look at it is, Fred, that you're actually paying for the marketing of these new apartments and new units. So what Margaret said before, and Brad will, as a QS, will go into it in more detail, is that at the moment you're buying it new, but when you go to sell it in 5 or 10 years' time, it'll be a 10-year-old apartment. So, you know, that premium that you've paid today, is it worth it? That's the question.
Good question, Brad.
I think with any new property, new estate, new units like that, it's always good to look at what the second-hand market in the area is doing, and you've really got to have some sort of comparison between those two and go, is it close enough so that when this becomes not shiny, because it's new and shiny, if you want new and shiny, then you pay a little bit more, like a car, for new and shiny. But there's that bit of a drop when it becomes not new and shiny, when they're building lots of them in the same place at the same time. And it depends on that comparison and what it's going to look like in 3 to 5 years' time when they all become second-hand. I think I think that's the best thing to look at.
Yeah, and we also have to consider the fact that because there are quite a lot of new units coming on, we're able to demonstrate demand at the moment with the current level of units. But is there going to be as much demand when all of those new ones come on? Is there a danger of oversupply? It's all well and good to buy a brand new unit when you're going to live in it because we're prepared to pay a premium for a property that we want to live in. But when it comes to a property to invest in, very often the extra money that you pay won't get you that much extra in rent. It's got to come down to a financial decision as well. So just check the supply factor and make sure that there's not going to be an oversupply in Liverpool, and then check what you can get an almost new or a 5-year-old unit for, and see whether that big difference in the purchase price results in a big difference in rent return or not. And I'd suggest that the ones that are a bit older might get you a better yield. Well, it's a pleasure to have you on board this Monday night. We have so much more to get through tonight, but we do have to pop off for a quick break. Stay tuned, though, because we'll be back soon. And if you do have a question for us, call to join the queue on 1300 30 34 35, email property@skynews.com.au, or tweet your question to Margaret Lomas AU. You never know, you could win the question of the week. We'll be right back. Welcome back. If you've just tuned in, this is Your Money, Your Call. And if this is the first time you've joined us, my expert panel and I spend a full hour and a half answering your questions and discussing what's making news in property. Tonight, Brad Beer from BMT and Brad Matthews from Rescom are here and ready to help you. So call us now on 1300 30 34 35 to join the queue, or you can call us or email us on property@skynews.com.au. And now you can even tweet me at Margaret Lomas AU. Now, Brad, I'd like to have a quick look before we go to the callers on at depreciation. And most people these days know a fair bit about depreciation. We certainly know more than we used to. But there's still some clever little strategies or little things about depreciation that a lot of people just don't know about. Tell me some of them.
Yeah, look, they're much better than they've ever been, I suppose. A lot of education's gone on over time. And I think things like making sure that depreciation schedules... When you're renovating, a term we call, and it's not really the tax office term, but something we call scrapping to make it easy.
I thought it was a tax office term. Did you make it up?
No, well, we didn't make up the word scrapping, but we applied it. It's really...
You made it up.
Writing off the residual value of items in a property, and that's really much harder to understand.
Yeah. I like scrapping.
I like scrapping as well. We use scrapping as that term because it just explains what it is in a lot more detail. And really what it is about renovators. People that have old properties and people that renovate properties don't kind of understand how depreciation works properly with that. And when you're throwing things away in a property or scrapping them, for a better term, that's easy to understand, they have some value. If you've bought this property and it may be a bit older, it still has some things in there that if you do a renovation and throw them away, had some value. You know, the important thing is to get them looked at first, so that you're having a look at what's there, you've got some value on these things, and when you throw them away, you claim the rest of that value straight away.
So you can write it straight off. So if you got, for argument's sake, say you throw away $5,000 worth of old stuff,
yes,
then you basically could get back, if you're on the 30 cents in the tax bracket, $1,500 that year.
In cash straight away, in that financial year. And it does... People are always like they're calling after they do these renovations and going, what about scrap? I've done a renovation now, I've got to get depreciation looked at. It's probably important for us to look at it before, because if you do get any type of audit at a later date, we can say we've been there, we've seen it, we've seen all that stuff before you actually threw it away. An instant deduction, it's often it's often $10,000 worth of stuff that gets kind of thrown away, which makes a pretty good cash difference.
$3,000 to $4,500 back.
Good dollars back in toward that renovation, I suppose, that happens afterwards.
Now, what about, a lot of people talk these days about split depreciation reports, where husband and wife, for argument's sake, own a property and they both work. What's the benefit of a split report?
So splitting the depreciation schedule up is not as simple as, well, it's $10,000 in deductions, I'll have half and you'll have half, if it's a 50% owned property, because it gets treated a little bit differently, and we look at splitting the value of assets in that property as opposed to just splitting the overall deductions. And with lower value assets, it actually makes a bit of a change to the way in which we claim some items. And what that means is, if you split it properly by splitting the assets as opposed to splitting the numbers afterwards, you can often end up with more deductions in those early years. It's like in common areas on strata titled properties in most states, you get to claim your percentage of ownership of items in there, and you kind of get to split those up based on what you own of them as opposed to otherwise. So being properly split for common areas and also split for just percentage of ownership. Sometimes if someone owns 10%, a lot of the things fall into this low value category and get claimed a lot quicker.
So when something ends up having only a small value, or you've been writing it off for a couple of years and its remaining value gets little,
yes,
then it all gets tossed into this pool, doesn't it? And whatever it was claimed at before, say it was before it was 20% a year, once it goes in here, it's like 37 or something like that, isn't it?
Yeah.
For whatever's in there in that whole year. So your remaining value actually suddenly gets a bigger deduction.
That's right. Now, it happens if you own the whole asset, but if you only own a small percentage of the asset, it gets down to that lower value quicker.
Yeah,
so,
that makes sense. So you guys only just thought of that because you never let me do any of that when you gave me the depreciation schedules of my property. What's going on there?
We can always split them up. We've been splitting those schedules for a while now.
Does that mean more money for me to pay to get you to do that?
Yeah, but depends Depends how messy it was in the past, Margaret. But it's pretty easy to split them up, and sometimes it does become a bit confusing for the client. So trying to explain to them they need to split and all those things, sometimes the accountant doesn't want to do it that way. We work with them on that to make sure it's done whatever's best for them.
Well, Lisa's called in and she has a depreciation question for you. Lisa.
Hi, Margaret. Thanks for taking my call. Yes, I've got a depreciation report and I'm tossing up between diminishing value and prime cost method. Can you sort of tell me the pros and cons of each, and is there one that you'd actually pick over the other?
Yes, there is actually, but it depends on the circumstances, doesn't it, Brad?
It does. Now, when we, as quantity surveyors, when we do a depreciation schedule, Lisa, we always... they should, and we do, give you both, prime cost and diminishing value. The difference is kind of diminishing value is claimed based on a diminishing value, I suppose, each year. So it's a higher percentage that you get to claim against these items. So it's a higher amount in the first or in the early years, but each year that percentage is claimed based on the residual value each year. So you're claiming a higher percentage of what's left. The prime cost value is a lower percentage, but it's the same amount each year to when it runs out. What it means when you graph the two, and we graph them in the reports, is that you get high deductions out of diminishing value in the early years, but the curve sort of flattens out, lower in the later years, basically. So the difference for you is what your tax position in these years are. Now, I like my money today instead of tomorrow because more deductions today means more cash in my pocket today. But if you're pushing yourself up or down into low tax brackets and you're not going to get as much benefit from that, then maybe considering the prime cost method may be for you. Or if you, in 3 years' time, know you're going to get a massive pay rise and be on a higher tax bracket, deductions work better for you in year 3 or 4, then it's a way to consider. We compare the deductions. Really what you've got to do is, with the help of your accountant, look at your own financial situation, how much of that you do get back in those years. But diminishing value usually always wins because more money today I can use to reduce debt, put into offset accounts, and I get it today instead of tomorrow. So it's got a time value of money attached as well.
Brad M., even people who buy brand new properties often don't realise how valuable this depreciation can be to them.
Margaret, I've been investing in properties for about 25 years, and it was only 5 years ago that I found out from Brad about scrapping. So I felt like the local village idiot.
Imagine how much money you wasted.
No, don't even go there. Don't even go there. Yeah. I said to him one day, he said to me, "Oh, you're scrapping." I'm like, "Scrapping? What are you talking about, scrapping?" He said, "But you've been doing this for a while." I said, "Yeah." And went through it, and it was just that blinding flash of the obvious. Light globe went on top, and I went, "I don't believe this." So, yeah, so you can talk about new investors buying new properties, you can talk about experienced people too. Well,
you know, the funny thing about it too is that often people don't want to go and get depreciation reports. They want to either have a go at it themselves or get their accountant to estimate things. But the depreciation report, so much easier. Everything's there in that one report.
Can I sell it for him without it looking like a paid advertorial? It is the best, you know, $600, $700, $800 you'll ever spend. It's tax deductible in that year. You can carry it forward for the next 10, 15 years. You can get it done again at a later date by another QS if you wanted to. It just makes no sense if you're an investor never to get one done. It's just crazy.
Yeah. You know, the other thing too, Brad, is that I recently found out from my good friend Julia Hartman that... Now, I'm probably going to get this wrong, and if I do, she'll write to me and tell me anyway, and then I can correct it next week. But my understanding is that if you buy a property that's available for depreciation and you're aware that it is, then you choose not to claim the depreciation because some people think, I've got to pay it back at the end and I don't want to claim it. If you're aware that it's available for depreciation and you don't claim it, the tax office can treat you as if you do.
Now, that used to be the case. They've actually kind of changed that rule a little while ago now, and Julia's written some stuff on that, and she'll have that right. But, you know, back when that was actually the rule, it's like you really are mad because it seems a bit wrong. They're going to make you do it anyway. They've kind of changed that rule a little bit. But the thing is to look at the capital gains tax issue because it does change what you do paying capital gains tax at the end. But we've written case studies. We've done case studies on, okay, okay, do you want $100 and give the tax office $34 later or something?
Yes.
And do you want your $100 now and give them $34 later, or whatever the numbers actually are in the case studies? And it's like, I get my money now and I may have to pay some more in capital gains tax at a later date. It's madness to not really do it that way.
And the bottom line is, you don't pay, whatever you claim today and get back today, that's not the amount that you pay back.
No.
Because it's only your portion of capital gains tax on half the gain. So it doesn't work out the same. Plus, with the time value of money, get the money today, pay it into your debt, buy equity in property, and not only is your dollar worth more today than it is in 10 years when you sell the property, but that dollar buys property, buys equity, and that equity buys more property, so exponentially you get to have a broader base in the market sooner.
Absolutely. Like, money today, as long as you don't use it on the wrong things, is much better.
Like the club.
And it's more than later. Look, the two most regular questions in reference to why people don't do it that I ever come across are really simple. One would be, but I think my property's old, and it's simple. Old property still gets depreciation. It doesn't get as much, but it still gets some. So why don't we ask someone who knows about that, as opposed to go, well, I think it's old, so maybe I won't get some. We'll have a look at that property and see if there's going to be enough deduction in that property, because when we can see the photos, we've got realestate.com, RP data, all those things now, we can see enough information to tell you whether or not it's going to be worth doing it before we go ahead and do it. And the other one is that people just think their accountant actually looks after it all the time. My accountant, I've got a good accountant, we work alongside them, we do a thorough job of depreciation, which is one of the numbers needed for the overall tax return that the accountant does.
Well, it sounds like all good advice to me. Let's go to the emails, and this is from Brendan, and he raises a question which was very much in the news last year. He asks, today I received a letter from the Lockyer Valley Council stating that my property will now be rated higher than residential properties as it's not my principal place of residence. Council states that they need extra money and they're not allowed to put up rates. Is this legal and is it ethical? Well, look, the only thing I can say, Brad M, is that I don't like all of the councils to do this because I think it's unethical. But it's interesting that Lockyer Valley admitted they were doing it because they needed more money and they didn't want to put up the rates. Good on you, Lockyer Valley. Lucky it's not last week's show. We're having a go at everyone. I would have had a go at Lockyer Valley as well. Well, I might as well anyway, because come on, stop treating property investors differently. Now, you know what happened last year, and this is going to stun the viewers because it certainly stunned me. Last year, a group of investors took Mackay Council to court over this because it was illegal. It was illegal to charge investors higher rates than they charge property owners or owner-occupiers, because they're only providing exactly the same service, and they've got a two-tier service provision cost, which was illegal. And there was 26 councils who were doing it in Queensland, only in Queensland, of course. And so what happened was Mackay Council lost the case, and the next thing that happened was the Queensland state government snuck through Parliament on page 150-something of an environmental bill, a law to make it not legal. So now it's not legal in Queensland to charge investors higher rates than owner-occupiers. What do you think about that, Brad?
I think it is absolutely disgraceful. Absolutely disgraceful. Any council who does that, you know, they should be hung, drawn and quartered, because they should look at balancing their books by all sorts of means, not just taking the lowest common denominator, the path of least resistance, and hitting a landlord. They should look at balancing their books, both their income and their expenditure, rather than just saying, well, we'll increase our income just by taxing others. You know, they have to look across the board, and that's just picking the low-hanging fruit. It's horrible. It's utterly disgraceful.
Brad, Brisbane Council allegedly said to an investor who queried why they were charging higher rates that it was because property investors get a tax deduction. Now, if we follow that thought through for a moment, and if that's indeed the case, A, why does Brisbane Council think that they deserve to share in that tax deduction? And B, they should then charge investors differential increases in rates, because all property investors get different levels of tax deduction. So some get a little bit and some get a lot depending on their income.
And I mean, it's a it's just not really very fair.
It's not cricket, is it?
It's not cricket at all. It's gouging. I'm happy to for the services that I use in my life, in whatever they are, to pay a fair and reasonable amount to get whatever it is done. But when you sometimes feel gouged, and for reason that you get a different tax, and it's a different amount of money for your tax rate and so many things, that I just think it's rude to actually charge a different amount. Unless you're providing some sort of different service. It's like, you know what, I think you can pay more so you get to pay more.
Yeah, I know, exactly.
It's just not right.
And a lot of property investors can't afford to pay more. Property investing is their one and only means of trying to prepare for a retirement and not be a burden on the government.
What the council actually doesn't do in this situation is actually get any debt against that property, take any risk. Property investors, like any investing, I've got lots of debt. I've got some properties, and I take a risk with that debt for my future, looking for the growth out of that future, etc. The council charges me more because I actually take a risk in looking to provide for a future, and they take none of that and just go, well, you've probably got more, so we'll charge you more.
Yeah. Well, look, all I can say to Lockyer Valley, and I hope Lockyer Valley Council is listening, shame on you, shame. You are disgraceful. And all of the other councils in Queensland who are doing the same to property investors, disgraceful, disgusting, and we should all just sell all of our properties and get out of town so that your areas go down in value, and hopefully your own properties, all the decision makers' properties, also go down in value. Stop trying to come up with excuses for what is simply profiteering, because that's all you're doing. You're trying to make money out of people who can ill afford to be coughing up for even more money. The banks have already gouged us with extra interest rates on our loans. We don't need you doing the same. Thanks for tuning in tonight. It's a happy show tonight, and it's time for a few messages. But when we return, you'll get another chance to get hold of a copy of my book, How to Achieve Property Success. But you will have to ask a question and have it selected. Now, you can do that three ways. You can call us on 1300 30 34 35. You can email us on property@skynews.com.au, or you can tweet Margaret Lomas AU. We'll be right back soon. Welcome back to the new Longer Your Money, Your Call, where we are now taking your calls and questions for an hour and a half every Monday night. I'm Margaret Lomas, and joining me is Brad Beer from BMT and Brad Matthews from Rescom. Now, I'm sure you also have a question for us, so grab the phone and dial 1300 30 34 35. Email us on property@skynews.com.au or tweet Margaret Lomas AU with your question. Now, in news this week, Sydney investors frustrated with the city's sky-high prices are heading south to scoop up cheap Melbourne real estate, according to developers. Now, with many buying property sight unseen based on the price difference. The trend is such that Melbourne developers are now targeting internet marketing directly at Sydney IP addresses, the same way that they would chase overseas buyers from China or Singapore. Marshall White Project Director Leonard Teplin said since March, Sydney investors had ramped up their interest in Melbourne and were purchasing without making the trip to see what they were buying. Domain Group median price data shows Melbourne units are $212,000 cheaper than in Sydney, with unit prices in Sydney surging by 13.9% last quarter to $656,000, compared with a more modest growth of 4.5% to $443,000 in Melbourne. Guys, I don't have a problem with people buying sight unseen, but I think we already talked at the top of the show about Melbourne units. Brad, they've got to be careful.
I know, but sometimes what you hear becomes an urban myth, because a project marketing director of a development company says that they're buying it, so all of a sudden people think that that's acceptable.
You think it's a marketing, you think it's a media release for marketing.
Sometimes it just happens. There are lots of people who do buy sight unseen.
Which is fine.
Yeah, you're buying in a block of 400, and in the block of 400 there's probably only 10 different patterns or styles of apartments that you're buying, but it just comes back to what are you actually buying.
So shall we then stymie the old marketing exercise and warn people to be careful about Melbourne apartments, because there's just too many of them?
I think it comes back to where you're buying. As I said right at the start of the show, I wouldn't buy in the Melbourne CBD an investment property.
Yes.
Okay. If I was buying in the Melbourne CBD to live, then I would look to see what the mix of the apartments are within there. So if I was to buy a home, which is an apartment to live in the city, then that's fine. But I would look, and if I knew that there was 350 or 400 apartments in there, and 300 of them are one-bedders and they're all 45 to 50 square metres, then I know the type of tenant that is going to be attracted to there. And I'm sitting there thinking, well, I wouldn't want to have a $1 million or $1.5 million or a $2 million apartment when I know that I'm going to be sharing my accommodation with uni students.
Well, you're a lot more polite than I am. I'm just going to say be very careful. Big oversupply in Melbourne, so Sydney buyers don't buy there because you think they're cheaper. The cheaper apartments might cost you in the long run when it's worth even less after you settle. Robert from Helensvale, you've got a question for us about Helensvale, is that correct?
Yes, that's right. Yes, I'm looking at potentially buying an investment house in Helensvale on the Gold Coast.
And you live in Helensvale as well?
No, I live in Sydney.
Oh, okay. You live in Sydney and you're asking about Helensvale. No problem.
Yeah, I've been doing a fair bit of research on the Gold Coast property market over the last few months. And I've just noticed since 2009, the Gold Coast property market has virtually done nothing.
Exactly.
And my feeling is the time could be right to buy there, not so much high-rise. I'm talking about a suburban home, and looking at the areas on the Gold Coast, Helensvale seems to be an area they've got big plans for it. What are your thoughts?
What's your feeling based on, Robert?
Well, the infrastructure that they've built that around, they've got the railway there, they've got the Westfield there, they've got a large population. Apparently there's considerable growth in population forecast for that region. So I'm just interested to know what you guys think.
Okay, Brad Beer.
Well, you've got some... see, Helensvale, you're not directly in the Gold Coast quite so heavily impacted on, I suppose, by holiday apartments, holiday everything, I suppose. So you're out, you're probably in suburban housing, which is something that is... We've got the opportunity to have the normal people that live there living there, as opposed to just holiday goers, where the market seems to move up and down based on how our Australian dollar and so many things, I suppose. So Helensvale, based on that proximity of being just out of really the Gold Coast, not necessarily anything negative from my point of view on that area. And prices aren't highly expensive there. I don't know what the returns are necessarily like, but they've probably got a percentage yield that's not too bad. So,
what do you think about Helensvale, Brad?
I don't know enough about it.
Don't know enough about it? Okay. Look, I spoke about Helensvale last week in terms of if you were going to invest in the Gold Coast, it would have to be somewhere around Helensvale because it's very close to the border where the Gold Coast then meets up through Mount Warren Park into Beenleigh with Brisbane, and there's an awful lot of industry and a lot of jobs and a lot of things happening in that middle part. People live around there because they can commute to both Brisbane and Gold Coast quite easily. I don't think it's going to go up because of infrastructure, because frankly I don't think the light rail is going to do a darn thing. I certainly don't think that the Commonwealth Games are going to do anything to Gold Coast either, and I don't think it's going to grow simply because it hasn't grown for all these years and it's time. I don't believe that either. But we do seem to have some good buys in Helensvale, and I think if anything's going to go up in the Gold Coast, and I really don't think all of those big McMansions are, and I don't think Broadbeach is, and I don't think anywhere where we've got dozens or hundreds and hundreds of apartments will, then it's probably going to be Helensvale, Coomera and all around that area. Having said all of that, I would suggest that a buy there, which will be okay, might be at the cost of a buy in other parts of Brisbane that will give you better growth. So have a look around all of Brisbane, go a little bit further north, a bit closer into Brisbane, as in Logan, a little bit above Logan, and see what you can find around there, Springfield Lakes, all of those areas first before you decide on a Helensvale buy. Well, it's now time for us to take a very short break, but when we return, you'll have another chance to ask your questions simply by calling us on 1300 30 34 35, emailing us on property@skynews.com.au or tweeting me at Margaret Lomas AU. We'll be right back. Welcome back to the brand new format of Your Money, Your Call. I'm Margaret Lomas. Joining me tonight on the show is Brad Beer from BMT and Brad Matthews from Rescom. Now, we still have time left for you to call in with your comment or question, and you may even be this week's book winner. So call now on 1330 3435. Email us on property@skynews.com.au or tweet the question. Come on, guys, tweet. It's like it's the 21st century. We tweet now. Tweet your question to me at Margaret Lomas AU. But before we do take those tweets that are just about to come through, in other news this week, a New South Wales senator has criticised the pace of ASIC's investigations of self-managed super fund property spruiking cases and has urged the regulator to consider whether additional powers would assist them in addressing the issue. Speaking to self-managed super fund advisor, Senator John Williams said that he's very concerned about the promotion of property investment through self-managed super funds by non-licensed businesses such as real estate agents, and said more needed to be done by ASIC. He said that his biggest bugbear with ASIC is the pace that they move with. He said that they need to act quickly, whether it's liquidators, financial planners or whatever. Mr Williams said that it's a frustrating situation, but that he hoped ASIC would be quicker to act in the future on these types of issues. Brad, it's not just self-managed super funds. I mean, really, and I've actually contacted John Williams' office and I hope to speak to him. The self-managed super fund is really the smallest issue with the spruikers. It's everybody else. Yeah. It's Mr. Everyday Mum and Dad who continuously gets sucked in by Mr. Spruiker, who pretends that he's giving them all this wonderful property investment advice, and under that he's actually selling them overpriced property. Yeah.
With a little rags to riches story, you know, I had to sleep on the couch of my friends for years because I was bankrupt or nearly bankrupt, and then all of a sudden, you know, I had this wonderful tablet and it made me into Superman, super investment advisor, and you should come to my, you know, my seminar, my workshop, and for you it's free, and then there's steak knives, and by the way, here's this property. These guys are unbelievable, and I don't know whether, well, I know that you could be, you know, I was going to say a rude word then. I know you can be really disappointed, you know, with these guys, or can you be disappointed with ASIC? You know, these guys at ASIC, they always seem to be so slow to come to the party.
Oh my God, it's chronic at the moment. And you know, the Department of Fair Tradings, or Departments of Fair Trading, all over Australia are all making bits of noise around it, and they're, you know, they're sending letters to people, and they're looking like they're doing something, but nobody's doing anything.
Nothing happens.
We've still got these people. Have you seen that one where the guy puts a thing in the paper with an open letter that his wife wrote him a letter or something and called him a loser or something, and then he changed and now he's this, because
he went to this course.
And everyone's always, you read these things and everyone's Australia's leading property expert, and you've never heard of them before, and you think, really? When did you become Australia's leading property expert?
There's so many rogues out there, and there is nobody doing anything about it.
Nobody's doing anything about it.
Every so often, somebody will stand up in either the Parliament or the Senate, usually on the opposition, and point the finger at the other side, and then 2 to 3 years later, they're on the other side, and then the opposition at that time is then pointing the finger. It's going on for 10 years.
Look, I've been lobbying the government for 10 years, and I can tell you that when the Labor government was in, the Liberal government were very supportive. Yeah. Oh, they were talking about all the things they were going to do to help us get this regulation through. Well, I was having meetings with them. It was all yes, yes, yes.
In opposition.
They were asking questions at the Senate Estimates Committee for me. The minute they got into Parliament, they don't even answer my email anymore.
Thanks.
I know.
Bye.
I'm anathema to them. Brad?
Oh, look, I think an important thing about anything you do is disclosure, and we talk about the price and dollars being built into things that are not realistic and not right. When I buy something, I want to know that what I'm buying is what I'm buying.
Yes.
And I don't have hidden things in there, and I'm being charged for things I don't know about and shouldn't be. And it's really sometimes difficult to check and see what is value and what is not value, and when people tell you lies about what is value and what's not value, you've got to start going and looking, well, okay, it's new, it's shiny, what's its value look like in comparison, like we were discussing earlier, to the second-hand unit that's 3 years old just up the road? And in 3 years' time, am I paying too much of a premium, and why is that premium there? Now, guys, people that sell properties deserve to, if they sell a property, to get some sort of commission out of selling that property.
Sure.
that's fair.
I agree.
It's when it becomes not fair,
yes,
and things end up loaded heavily. Anything you buy in life, really, that's loaded heavily by someone who's taking a cut in between that's not a reasonable cut for services offered and what you're actually doing. Then,
and it's usually a middleman somewhere. He's got the stock from a developer. If someone said to you, here's a property for $400,000, and they disclose to you, I'm going to make $42,000 off this, you'd have to think, where's it coming from? And they try to say, oh, you don't pay it, and it isn't loaded onto the purchase price. I'm getting part of the developer's profit.
Marketing.
That's ridiculous. $40,000 on a $400,000 property is not suitable.
And it's not a fair amount of commission for the work that you've actually done, is what the problem is there.
Exactly. And then we have all of the ones who do the land banking. We've got that land banking scheme from Ballarat that's just gone south.
Your friend.
Mr. who keeps on surfacing and hiding and surfacing, and the guys who get their picture taken with
every 21st
money
century.
With their money in a suitcase and cocaine on the table and all that kind of stuff. These guys, they're runaway trains. They're total crooks.
And they keep coming back every 3 to 5 years,
so
reinventing
why?
Themselves.
Why do they keep coming back?
Talk to ASIC.
Why can't ASIC get rid of them once and for all? All they do is phoenix into something new.
No, sorry, part of it is these guys have made so much money that they get the best lawyers